Bull and bear markets represent the two primary market conditions in financial markets. A bull market is characterized by rising prices and optimistic investor sentiment. It's typically defined as a period when stock prices rise by 20% or more from recent lows. Conversely, a bear market occurs when prices fall by 20% or more from recent highs. Bear markets are accompanied by widespread pessimism and negative investor sentiment. These terms originated from the way these animals attack. Bulls thrust upward with their horns, symbolizing rising markets, while bears swipe downward with their paws, representing falling markets. To summarize, bull and bear markets represent opposing market conditions with distinct characteristics. Understanding these market conditions is fundamental to making informed investment decisions. Let's examine the key characteristics of bull markets. The most obvious characteristic of a bull market is consistently rising stock prices. While there may be occasional dips, the overall trend is upward over time. Bull markets typically coincide with strong economic indicators. These include low unemployment rates, robust GDP growth, and increased consumer spending. During bull markets, investor confidence is typically high. Market participants feel optimistic about future performance, which fuels further buying activity. Increased corporate profits are a hallmark of bull markets. As businesses report stronger earnings quarter after quarter, this fuels investor optimism and justifies higher stock valuations. Bull markets are characterized by high trading volume and liquidity. As more investors participate in the market, it becomes easier to buy and sell assets without significantly impacting prices. During bull markets, investors typically display a greater appetite for risk. They often shift from safer assets like bonds to more growth-oriented investments like stocks and other higher-yielding assets. Bull markets typically see an increase in initial public offerings, or IPOs. More companies go public to capitalize on favorable valuations and strong investor demand. Even during bull markets, temporary price declines or corrections occur. However, these corrections are typically short-lived, with the upward trend quickly resuming. Bull markets can last for extended periods, often spanning several years. One of the longest bull markets in history ran from 2009 to 2020, lasting nearly 11 years before the COVID-19 pandemic triggered a market downturn. In summary, bull markets are characterized by rising prices, strong economic fundamentals, high confidence, increased profits, high trading volume, risk-taking behavior, IPO activity, quick recoveries from corrections, and extended durations. Let's examine some of the most significant bull and bear markets throughout history. Throughout market history, we've seen several major bull and bear market cycles that provide valuable insights for investors. Let's first look at some notable bull markets. These are extended periods of rising prices and investor optimism. The post-World War II boom from 1949 to 1956 saw the market gain 267% over 7 years, driven by economic expansion and suburbanization. The 1990s tech boom was one of the most powerful bull markets, with the S&P 500 rising 407% over a decade, fueled by internet innovation and technological advancement. Following the Great Recession, markets experienced an 11-year bull run from 2009 to 2020, with gains of around 400%, supported by low interest rates and tech sector growth. Now let's examine major bear markets. Periods of significant decline and pessimism. The Great Depression triggered the most devastating bear market in history. From 1929 to 1932, the market lost nearly 90% of its value, leading to widespread economic hardship. The oil crisis of 1973 to 1974 created a bear market with losses of 48% as oil embargoes and inflation ravaged the economy. When the dot-com bubble burst in 2000, markets declined 49% over 2.5 years as overvalued tech companies collapsed. The 2007 to 2009 financial crisis saw markets drop 57% as the housing market collapsed and major financial institutions failed. Most recently, the COVID-19 pandemic triggered an unusually brief but intense bear market in early 2020. with a 34% decline in just 1 month, followed by a remarkably swift recovery. Looking at these historical examples reveals important patterns and lessons about market cycles. First, markets invariably move in cycles, with periods of expansion followed by contraction. Second, bear markets are typically shorter but more intense than bull markets. Third, bull markets generally last longer and generate steady returns over time. And fourth, external events like wars, crises, or technological innovations often trigger transitions between market phases. Understanding these historical patterns helps investors maintain perspective during market volatility and make more informed decisions about their investment strategies. Each of these historical market periods offers valuable insights into investor behavior and market dynamics. Market psychology plays a crucial role in both bull and bear markets. During bull markets, investors often exhibit herd mentality, following others into investments out of fear of missing out, or FOMO. Herd mentality occurs when investors follow others, making decisions based on emotion rather than analysis. This can lead to irrational exuberance and asset bubbles, where prices rise far above their fundamental values. In bear markets, fear dominates, sometimes causing panic selling and driving prices below fundamental values. Panic selling occurs when investors rush to exit positions simultaneously, creating a cascade of selling pressure. Behavioral finance studies show that investors tend to be overconfident during bull markets and overly pessimistic during bear markets. Understanding these psychological biases is essential for making rational investment decisions, regardless of market conditions. Investment strategies for bull markets focus on capitalizing on the overall upward trend in prices. During bull markets, several key strategies tend to outperform. Let's explore the most effective approaches. Growth-oriented investing is particularly effective in bull markets. Investors typically increase allocation to equities, with a focus on sectors showing strong momentum, like technology or consumer discretionary. Buying on dips involves purchasing stocks after small price declines. This strategy takes advantage of temporary weakness in otherwise strong stocks, allowing investors to enter positions at better prices. Using margin involves borrowing money to increase your investment position. While this can amplify returns during bull markets, it also increases risk significantly and requires careful risk management. Momentum investing focuses on stocks already showing upward price trends. This strategy tends to outperform in bull markets, as winning stocks often continue their upward trajectories. Dollar cost averaging involves making regular investments at set intervals, regardless of market conditions. This disciplined approach works well in bull markets, especially when investing in broad market index funds. Even in bull markets, investors should remain vigilant for signs of market tops. These warning signals can help you adjust your strategy before a potential downturn. Identifying market transitions between bull and bear markets is one of the most challenging but crucial skills for investors. When trying to identify market transitions, investors typically rely on four main categories of indicators: technical, fundamental, economic, and sentiment. Technical indicators look at price and volume patterns to signal changing momentum. Moving average crossovers are popular signals, where faster moving averages crossing above slower ones suggest bullish trends. Trend lines help identify directional changes, with broken trend lines often signaling potential reversals. When a downtrend line breaks, it might indicate a shift from bear to bull market. Market breadth indicators measure the number of advancing versus declining stocks, helping to confirm the strength or weakness of market trends. Fundamental indicators focus on the underlying financial and economic factors. Yield curve inversions, where short-term rates exceed long-term rates, have preceded nearly every recession and bear market. Valuation metrics reaching extremes, such as very high price-to-earnings ratios, often signal the late stages of a bull market. Meanwhile, deteriorating corporate earnings can indicate an approaching bear market. Economic indicators provide broader context for market transitions. Rising unemployment often precedes bear markets, as it signals weakening economic conditions and reduced consumer spending. Declining consumer confidence and manufacturing contraction are also warning signs that often appear before significant market downturns. These indicators tend to lead market movements by several months. Sentiment indicators measure market psychology and can signal extremes. The VIX, often called the fear index, measures expected market volatility. Spikes in the VIX often coincide with market bottoms, while extended periods of low VIX readings may indicate complacency before market tops. Put-call ratios measure whether investors are buying more put options, bearish bets, or call options, bullish bets. High put-call ratios often indicate excessive pessimism that may signal market bottoms, while very low ratios suggest excessive optimism that often precedes corrections. While these indicators can be helpful, it's important to remember that no single indicator is foolproof. Market transitions are complex, and each indicator can produce false signals. Successful investors monitor multiple indicators across different categories, remain aware of confirmation bias, and pay attention to economic conditions and central bank policies. Most importantly, maintaining proper diversification provides protection during unpredictable market transitions. Despite periodic bear markets, long-term market trends have historically been positive. U.S. markets have averaged about 10% annual returns over the past century. Bear markets, while painful, are normal parts of market cycles and typically shorter than bull markets. For long-term investors, bear markets present buying opportunities rather than reasons to abandon investment plans. Dollar cost averaging through all market conditions has proven effective for building wealth over time. Understanding that both bull and bear markets are temporary helps investors maintain discipline and avoid emotional decisions that can damage long-term returns.